So if it were to be Solomon, what will happen? All right, look at it. After this is correction. All right, you have this. This is the demand level. The demand level that created that push up. Look at it. We want that demand level to be mitigated and fail to make a higher high. So right now, it failed to make a higher high. So as it failed to make a higher high, the breakdown is your impulse. All right. So if you take a fib of this level down to this level, this is your entry and this is your TP right here. Okay. Now, the issue is this. At what time did this mitigation of this supply happen? Look at it. This is 4 o'clock. This is 4 p.m. Okay. You are not going to take that because you don't trade. You don't expect, we don't expect you to trade euro dollar at 4 p.m. So what will you do? You wait until overlaps, until London starts. Okay, and look at the time London starts here. That is 8 o'clock. That is where you should have your entry. Boom, extend it down. But the bone of contention now is where is the appropriate level to place the stop loss. Okay, you see this demand level. This is the resistance level where we decided that we're going to look for sell. All right, and now based on the supply, okay, the supply upon which you base your entry, this is your resistance level around this level. So many people will now take entry here and put stop loss here so that they can get 1 to 10 RRR. But what we are saying is that, of course, we learn every day. We learn every day. What we are saying is that we have to sacrifice this 1 to 10 RRR, okay, for a lower RRR. We put it here. We put it here. So our 1 to 10 has become 1 to 3. Our 1 to 10 has become 1 to 3. We have sacrificed that RRR. And at the end of the day, if we want to risk 100 US dollar, both the man that did 1 to 10 and the man that did 1 to 3, both of them are risking 100 US dollar. But if the trade should go in the favor of Mr. A, trader A, that is 1 to 10, he will be getting 1,000 US dollar. And then the man, the trader B that risk $100 and getting 1 to 3 will be having 300 US dollar.
300 US dollar.
But the gentleman that had planned for 1 to 3 RRR has, let me say, 90 to 95% probability of the trade not hitting his stop loss.
Wow.
Because he has put his stop loss at an institutional level where institutions don't go back after they have left the place. They don't go back there after they have left. That is where he has positioned his stop loss. But the gentleman who wanted 1 to 10 RRR has positioned his stop loss at the retail space where the slightest move in the market will take him out. And you know what? He has lost 1 hour. That is $100. And if the market goes back and the other gentleman is still in the trade, and if the market goes back, he says he wants to enter like this, and before you know it, maybe market goes like this again. He has lost what? 200 US dollar. But this man who is interested in just getting his 1 to 3 RRR is still in the trade. So why you are, you are going through that pain having lost 2 trades in one setup. Your friend is still in the trade. The only thing is that he has little drawdown to contend with, but that is not a problem. Drawdown is not a loss. He has given himself enough buffer. Okay? He has given that allowance within which to allow the market to operate. He has given that, that allowance for price to operate. Do you understand? So now the implication of this is that this man who wants 1 to 10 will eventually get this after maybe losing it 3 times. He has first lost $300 before eventually getting 1 to 10. And let me tell you, at the end of the day, when he's even getting it right, by the time he pulls down a little, because his lot size is big, so he quickly see a big profit, he quickly close his trade and run away. Maybe after getting like 1 to 3, just $300, he will quickly close the trade. And then that $300 will go and block and offset, that's the right language, it will go and offset the $300 that he has, he has lost before on the same trade, remaining at the same level. But this man who plays his stop loss at this level, the trade kept going up and down, he still remained in the trade. And because his stop loss size is big, of course you know that his lot size will be what? Will be small. It will be so small that even when the market pulls a little into his favor, the profit is what? Is small. So he's not moved by the profit level that he's getting. He's not moved. And that is how the market will push like this, and he will get 1 to 3 RR, which is $300. So you see, he has gotten his $300 and he has lost nothing. This is the same process he will repeat, that in every 10 trades that he takes, he will be, and he's getting 1 to 3 on the average, least RRR on the average, he will be winning 8. And he will be losing or break even in 3. Even these 3, he wouldn't lose them. Okay? He wouldn't lose them. Most of the time, it will end up in break even if that trader is a fantastic analyst. So you will see that he's getting break even in 3. He's getting what? 8 wins. And 8 wins times 3 RRR is 24%. He has made 24%. But this gentleman, he has not even made a big kill, and he has lost like 7 or 8 trades. 7 or 8 trades just in a bid to get 1 to 10 RRR. Are you getting what I'm saying now? Are you getting what I'm saying now?
Yes, sir.
Just because he wants to get 1 to 10 RRR, he has lost 10 trades. He has lost 10 trades. Okay? So that is why I sent a message. You know, there are some of my friends that I have been telling them this thing for a very long time, that you need to choose between getting a very good RRR and getting a very poor RRR but make money consistently on a daily basis. And I have proved it to them that it's very good. It's very, very good to make a big RRR in trading. But by the time you are making some losses in that process, you will see that those losses will kill your psychology. And by the time you are devastated, by the time you are frustrated by the amount of losses you have incurred in the process of exercising your greedy nature in trading Forex, you will see that at the time you want to believe that Forex trading is a scam. You want to follow the bad wagon, that Forex trading is a scam. Whereas you yourself, you are a scam. Somebody who is a scam, a greedy trader who is a scam is alleging that the market is a scam. The market is not a scam. If you do it wrongly, you will get the repercussion in a way that you don't expect. So that is how it is. So every trader must now have to make a choice between sacrificing big RRR for daily consistent profits, or you want to remain in the quest to obtain big RRR and be recording losses day by day, break even day by day. Let me tell you this. If you put your stop loss at the daily level, okay, it does not mean that you are not still going to be timing your entry in your 1 minute, in your 5 minutes, or you will still be timing your entry there. But at the time you get your entry, bam, give gap, go and place your stop loss at the daily level. But make sure that you have a kill at that key zone, boom, and then allow the trade to run. Okay? So that is a way to go. You will see that even if you don't get more than 1-to-1, you are risking $100 and you get $100. You take your profit, you go. Fantastic. In as much as you place your stop loss at the right place, even if you are getting 1-to-1 every day, and you are taking it, at the end of the week, you will laugh. You will thank God for what he has done for you for that week. You will be grateful to God. This idea of big RRR is, is one idea that set confusion everywhere. Let me tell you this, and I have told you before. Bank don't trade by placing stop loss. They don't trade like the way we are trading. Their way of trading is different. When they see that all fundamentals support bearish euro dollar, okay, they sell off the positions they have. When they see that all fundamentals support bullish dollar, they acquire euro dollar. They just acquire it and keep it. But you have opportunity of leverage. That is why you have 1,000 and trade 100,000. They don't have opportunity of leverage. Do you understand now? So that is how this thing works. Okay?
Yes, sir.
That is how it works. Yeah, that's how it works. Yeah. So now let's do another example. Let's go to this pair. Fundamentally, if you go and analyze euro and GBP, fundamentally, right from here, when this was here, I was monitoring. It has to get here and drop. Why? I have a friend who trades this pair, who told me to help him to analyze it. I said, okay, that if you want to analyze anything in the financial market, you will start from the fundamental. You will start from the fundamental, because fundamental analysis gives you direction. While technical analysis give you precision of where to get in. So, and there are 3 basic questions that you need to be able to ask yourself when you are trading. Number 1, what to trade? What to trade? Number 2, how to trade? And number 3, when to trade? These are the 3 questions. Then the first question, which is the most important question, because if you want to do a business, you must ask yourself, which business do you want to do? You must be able to know the business to do. If you don't know the business you want to do, you just want to do a business, somebody asks you, you say you just want to do a business, then you don't know what you are doing. You must be able to say, this is the business you want to do. So the question of what to trade is answered by fundamental analysis. Which currency am I going to move my capital? Which currency am I going to hold? Which currency am I going to sell in order to make money from the differential in its movement? And in answering this question of what to trade, you must begin to now x-ray the interest rates, differentials of some of these pairs. What is the interest rate on Euro USD? What is the interest rate on Euro? What is the interest rate on GBP? What is the interest rate on NZD? You analyze this. Once you get their interest rate, you should know that a currency with a higher interest rate is the one that people want to acquire and hold for bigger interest. And the one with lower interest rate, people don't like it. Investors will not put their money there. So those ones will be selling off. You must first get that idea. Carry trade. And then secondly, you must ask the question, which one will have a better yield between USD and Euro? Which one has a better yield? Ask AI. AI will tell you. AI will even tell you as at February 2026. USD has a yield of 3.00%, while Euro has a yield of 1.00%. What does that tell you? It tells you that the one with a bigger yield is the one that investors want to hold. That's the one you want to acquire. And the one with lower yield, that's the one you don't want. You want to sell off that one. So if Euro has a lower yield and USD has a higher yield, which means you want to sell Euro USD, so that as you are selling Euro, you are using it to acquire USD and you are getting interest on it. So these are those things you need to first analyze. And the third thing, just as I've taught you before, you need to ask is, what is the valuation on Euro versus USD? That is, if you use an item, if you price an item in Eurozone, how much is it? If you go and price it in America, how much is it? If you divide it, if it's above the current market price of euro dollar exchange rate, it means that that asset, Euro, is overvalued and you want to sell it, which is fantastic. If Euro is overvalued currently and you want to sell it against US dollar, it's fantastic. So that is what you must first analyze in what to trade. And then the question of how to trade and when to trade is now answered by technical analysis. How do you approach the trading? Is it demand level you want to operate from? Is it from daily support and resistance level you want to operate from? Do you want liquidity to be taken before you go? That's the question, how to trade. That's where you answer it. And then when to trade, that's technical analysis. Okay, this is Euro GBP. Okay, Euro GBP, the liquidity will be taken for me to sell Euro GBP during European session, because Euro GBP has nothing to do with New York market. It has nothing to do with overlap, but it has all to do with the British market and the European market. So, and this market incidentally happens at the same time. So you know definitely that if you want to sell euro dollar, it's going to give you liquidity for sale during European session. And while we were here, that my friend asked me to help him to analyze this. I said, okay, now based on carry trade, we want to sell euro, we want to buy GBP, because the interest rate on GBP is 3.7 and the interest rate on euro is 2.25. So GBP is more attractive to hold. So we have to sell euro GBP. Secondly, if you look at the yield on GBP, it's about 3.7, while the yield on euro is about 1 point something. So it's more attractive based on yield to hold GBP and then sell off euro. And then in terms of valuation now, we can also use technical analysis to do, valuation model by using what we call exchange rate parity, right? So you can also use technical. Look at it here. If you look at purchasing power parity, rather, look at it here. You don't want it here. You want it to push up. So I said, let it push up. Once it push up to this level, look for sell. And I gave him the signal, and I also traded it. I say, okay, it has gotten there. He says it has gotten there. I say, no, don't sell. Allow the bearish momentum to come. Allow the bearish momentum to come. And look at it. Look at the bearish momentum. Bam. So as soon as it came here, we say, oh, open, close. This is our resistance. We want to sell. Boom. Want to sell on Tuesday 3rd. That was when we sold. Tuesday 3rd, we sold. Okay? So this is the impulse. Now, look at me. If you take this length, where you have 75 to 90, right here. Okay? Is that okay now? But is it a must that the market must get there? No. We are waiting for liquidity at European session. And anywhere this market push to and European session come, that will be our entry. Look at it. Look at it. Look at it. This is 9 o'clock. Bam, bam. This is our entry. Okay? Liquidity. Come down, pull back. This was our entry. Boom. Sorry. Look at it here. Boom. But did we put stop loss here? No, we did not. We did not. This was our stop loss up here. Yes, up there. Where was the TP? Look at the TP. Right here, from here to here. This was the TP. Boom. Okay? This was where the TP was hit. It's another one. This is where it was hit for just 1 to 1.89 RR. That was what we got in this trade. Not even up to 1 to 2. But we were sure 95% probability, we had 95% probability that the stop loss will not be hit. So it was better for us to have gotten almost 1 to 2 RRR, right? It was better for us to have gotten 1 to 2 RRR with greater confidence than for us to want to get 1 to 10 and not be sure that this trade will go. Do you understand what I'm saying now? You will not want to do that. Do you get now? So that is the idea. So that every day, any setup you take, once you analyze well, every day you will be making money. Even though that money is not big, but it will be coming every day. And I challenge you, if you do that, you must understand what is called a lot size calculation. Not that you are maintaining a very wide stop loss size and then you are still using high lot size. No. Assuming you have a $1,000 account and you want to risk $100, for instance. Let's say you want to risk $30. Okay? And the stop loss is, let's say, 30 pips. No, let's say 50 pips. So the lot size in this case will be how much you want to risk, $30, divided by what is the stop loss size, 50, times what? 1/10. 0 cancel 0. 3 here, 1. 3 in 50. 3 in 50. Or let's do it this way. 0 cancel 0 here. 3 times 1, 3. 5 times 10, 50. Okay? 3 in here, 1. 3 in 5 is what? Is what? Is 1. Remain what? Remain 2. 3 in 20, that's 16. So you're having like 1/16. 1/16 is what? 0.05 or 6.
1/6.
Yes. So your lot size in this case will be what? 0.06. 0.06 or 0.07, thereabout. Calculate it well. This is how to calculate it. So it's not that you are going to maintain a wide lot size and you are still using a 0.2 or 0.5. It will not work. You have to know how to do your lot size calculation appropriately. Okay, do it appropriately. Wait for liquidity to happen. That's how to do it. And imagine, I want you to do this experiment. I'm going to leave you with this. I don't even expect anybody to ask questions. No argument. Go to your house. Open your tap. Put a bucket under. As water is coming, lock this tap. Lock it to a point where water is just dropping. Just dropping. Let's say once in 5 seconds, or once in, let's even say 3 times in 1 minute. Let it drop like that. Go and sleep. Come back the next day morning. What will you discover? What will you discover? What will you discover? Not only that there will be water inside, the bucket must have been filled up. That is to tell you that, yeah, that is to tell you that when you are taking your money little by little on a daily basis, you are making profit on a daily basis. When you gather this little profit together, it makes a correct money. It makes a good money at the end of the week. It makes a good money at the end of the month. And you will smile. That is what is keeping most of us. That's what is keeping us. But the problem we have, I decided that I will tell you the truth. The problem we have had, is that most traders are using little capital. So most of we who mentor them, we have to grapple with a situation where we have to tell you different logic so that you can at least make money with your $100, so that you can make money with your $200. But I can see, because of stop loss hit, and we enter the same trade where I position my stop loss is different from where you position your own. You are losing your trade, you are losing your money, but my trade is intact. And at the end of the day, my trade will go into profit. I come out with profit. You have come out with 3 losses on one similar setup. Why? I have a bigger capital, you have a small capital. And I have taught you how you will now do it with your small capital so that you can make money. But I can see that it will not work that way. You have to do it the way I'm doing it. Place your stop loss at the daily level. If it is 0.01 you can do, and you can get $3 or $4, $5, $10, take it. But just know that you cannot blow with that. It's not possible to blow with 0.01. But you will not develop headache. You will not have headache while trading. Okay? You can feed yourself with that. Yes, give me $100. I will feed myself. I can feed myself with $100. Yes, trading it. So do the same thing. You in a month, you place your trade at the daily level. And if it's 1 to 2, 1 to 3 you are getting, and you are risking $5. When you get 1 to 2 is $10. When you get 1 to 3 is $15. At the end of the month, I can bet you, with the amount of technical analysis that you know, guys, you can double that money in a month. You can double that money in a month using that position sizing, putting your stop loss at the daily level, and using that small loss size. You can double your capital. But why are you trying to be greedy to own the whole world with a little money? That is the biggest problem. You want to use small capital to make a big money. It will not work that way. It will not work that way. All right? So I'm going to end this session right here, but we'll be back. We'll be back where I will entertain questions and answer. All right?